Welcome. This is John Martinka in another episode of the Getting the Deal Done podcast series. And again, this falls in our educational uh, part of the series. And today we're going to talk about an exciting topic, which is why I wore this colorful shirt. Uh, it's banking. Now I figured the shirt needs to brighten it up and lighten it up because it's banking, but it's something that is completely misunderstood by a lot of people. First of all, let's realize one thing. The golden rule has always been whoever has the gold makes the rules. And in this case, the bank has the money, the bank makes the rules. There's a lot of misinformation out there about banking and business acquisition loans and SBA loans. One of my favorite attorneys recently uh, was putting something into a deal that referred to banking SBA policies that were changed almost 3 years prior. Uh, So here's a primer. I don't claim to be a banker. I don't claim to be the expert, but I do know a lot more about these things than most people, uh, even people in related industries. So let's talk about different kinds of loans. There's really two kinds. There's a conventional loan and an SBA loan. A conventional loan is what we always think of as a bank loan. And it is where you go in and you borrow money directly from the bank, and it's a two-party transaction. They typically have a 5 year, maybe a 7 year amortization period. They are more or can be very collateral based. In other words, if there's no furniture, fixtures, equipment, vehicles, inventory to attach, you might not get the loan. And they typically require about 25% down, sometimes a little less, sometimes a little more. So who gets a conventional loan to buy a business these days? In the size range of where you could do an SBA loan. Well, it could be someone who is not a US citizen or have a green card, because you need one to get an SBA loan. Maybe too much liquidity. Some banks watch for that obscure rule. Investors. If someone's got investors and their investors say, I will not sign a personal guarantee, you are out of the SBA world. So let's talk about SBA loans. Misconception: the SBA makes loans. The SBA does not make loans that the type that we're talking about. Uh, they guarantee a portion of the loan to the bank. Right now, as I record this, it's 90%. It will probably go back down to 75% or so. There always are some kind of specific industry things where it might be more, but most of them are in that 75, now 90% during COVID range. 10-year amortization, really gentle on the cash flow. They are cash flow lenders. What does that mean? It means they don't need collateral. They will take collateral. They will take business collateral. They will take home equity, real estate equity. The more collateral you have, the better the rate often. Uh, and there's only 10% down. Uh, there's a there's another way to get buyer can get in lower than that, but it's very restrictive, and it's really only, if you want to get in at 5% down, the seller has to hold at least a 5% note for the full term of the loan, no payments, no principal, no interest. And I think it's only good for family or management buyouts. Uh, Now, some features of SBA guaranteed loans. First of all, the loan cannot buy cash, and the deal can't take over debt. There can be working capital, uh, accounts receivable and inventory, less payables and accrued liabilities with work in process thrown into the mix if there is any. You can get some cash included, though, if it's tied directly to a customer deposit for future work. But you just can't buy cash for working capital. The banks underwrite the loans to their standards. Then they make sure they fit under the SBA's guidance umbrella. So a couple of quick stories. A few years ago, one of my clients went to four banks, got 3 offers, SBA loans, exactly the same. And one came back and said, "Oh, we really like you, really like the business, but we think the seller note should be twice what it is." Say goodbye to that bank. Recently, Jessica's working with a client, and the client went to 2 banks. One is working on it and will probably approve it. The other one said no pretty quickly because they did not like the financial results 3 years ago. They underwrite it to their standards. Now, no matter whether it's conventional or SBA, we have debt coverage and debt coverage ratios. What is a debt coverage ratio? Well, the numerator is your free cash flow, not EBITDA, not operating income, not EBIT, not seller discretionary earnings. It is free cash flow. EBITDA plus owner's salary, less fair market owner's salary, and anticipated capital expenditures and operating interest. That's the free cash flow a buyer has to pay off the loan. The denominator are the payments, principal and interest. I want all my buyers to have a minimum of a 1.5 to 1 debt coverage ratio. And if it's a small deal, and typically smaller than the ones we work on, I want them to get up at 2 to 1 or better. I mean, I've had deals that have been 3 to 1. Great cash flow. So if your payments are $1 million a year, principal and interest, you need free cash flow of $1.5 million minimum. Now, take a zero off. If your payments are $100,000, I would want that buyer to have $200,000 of free cash flow to give them some cushion. That gap is what you use to grow the business, pay taxes, take a bonus, whatever else. So let's talk about the 5 C's of banking. They sort of went away. No, they did go away pretty much till the 2008 recession. And they are capacity. How are you going to repay the loan? Collateral, which, believe me, the bank does not want. They want it paid off. They don't want your truck, your house, your building, your equipment, etc. Capital. This is your skin in the game. This is part of your part of the down payment. Conditions. What's it being used for? Buying the business, equipment, line of credit. And then what I think should be on the top is character. The bank wants to lend to good people who will pay back the loan, are trustworthy, have a proven record of success. So banks do things their way, right? Banks are not investors. They are looking to be paid back. And it reminds me of a story with a client a number of years ago. And he's talking to a bunch of banks. And he comes to me and he says, the banks are not being very creative on this deal. And my response instantly was, the banks aren't in business to be creative. They're in business to be paid back. If you've ever owned a bank stock, you can appreciate that. So let me finish by reading to you something from a bank president. And it's in my book, Getting the Deal Done. And he was talking about home equity as collateral. So bear with me as I read this. If you aren't confident enough in your business and its prospects to mortgage your house and put your life savings into it, then why should I have confidence in you? Unquote. I think that says it all. You want to borrow money from the bank? You've got to be in along with the bank. So thank you for watching or listening. Again, this is John Martinka. We're talking about banks and banking and loans, especially for business acquisitions, as part of the Getting the Deal Done podcast series. All the best.